Right now, people are losing money in Bitcoin. Not slowly, not quietly. Billions are disappearing in hours. Charts are red. Retail investors are panicking. Influencers are silent. And while you're watching the price fall, the powerful are moving. This is not just another dip. This is a transfer from emotional money to strategic money. And almost nobody sees it happening. Bitcoin was supposed to protect you from the system. That was the promise. Freedom, independence, no central authority. But look carefully. When Bitcoin falls, it does not fall randomly. It falls in waves, sharp, precise, timed. Every time the market shows weakness, retail sells. Every time fear spreads, small investors panic. And every time panic hits its peak, large wallets start accumulating. This is not conspiracy. This is market structure. Bitcoin recently dropped hard. News headlines blamed volatility. They blamed interest rates. They blamed macro uncertainty. They blamed global instability. But none of that explains the pattern. Retail traders buy breakouts. Retail traders buy headlines. Retail traders buy hope. And they sell fear. Now look at the other side. Billionaires do not trade headlines. They trade liquidity. They wait for weakness. They buy fear. They hedge risk. They position before the narrative changes. Right now, Bitcoin is falling. Retail sees collapse. Institutions see opportunity. That difference changes everything. Think about this carefully. When Bitcoin was exploding upward, retail was euphoric. Social media was loud. Everyone was a genius. And during that period, large holders were quietly distributing. When price rises fast, liquidity increases. When liquidity increases, smart money exits without crashing the market. When price falls hard, liquidity disappears. When liquidity disappears, only strong hands can buy. This is how markets transfer wealth. Now bring politics into this. Bitcoin is no longer outside the system. It is inside the system. Governments discuss it. Regulators shape it. Presidents talk about it. Policy influences it. Trump has openly supported crypto. The United States has explored strategic positioning in digital assets. Large institutions now offer Bitcoin ETFs. Banks provide custody. Wall Street packages exposure. This is no longer rebellion money. This is institutionalized volatility. And when institutions enter a market, retail becomes exit liquidity. You need to understand something uncomfortable. When Bitcoin crashes, billionaires do not get liquidated the same way retail does. They do not use the same leverage. They do not use the same exposure. They do not panic at the same levels. They structure risk differently. Retail buys spot and holds. Institutions buy spot and hedge with derivatives. Retail buys with emotion. Institutions buy with models. Retail reacts to price. Institutions influence price. Look at volume patterns. Look at liquidation spikes. Look at on-chain accumulation during fear phases. Large wallets grow during panic. Small wallets shrink. This is measurable. This is documented. Now ask yourself a hard question. Why does this pattern repeat every cycle? Because retail believes stories and institutions understand structure. Bitcoin falls. Headlines say crash. Retail thinks the dream is over. Institutions check liquidity levels. Institutions check macro stress. Institutions deploy capital slowly. Not loudly, slowly. You never hear about it in real time. You hear about it months later when price recovers. Then the narrative flips. Media says resilience. Influencers return. Retail re-enters. And the cycle resets. This time feels different because Bitcoin is now tied to politics, tied to monetary policy, tied to geopolitical risk, tied to presidential narratives. When Trump speaks about crypto friendliness, markets react. When regulatory shifts happen, markets react. When institutional ETF flows increase or decrease, markets react. Retail reacts emotionally. Institutions react strategically. That gap is where wealth moves. Right now, volatility is high, fear is spreading. Retail investors are asking if Bitcoin is dead. They asked the same question in 2018. They asked the same question in 2022. They will ask again in 2026. The question never changes. The structure never changes. Only the players who understand it survive. And here is the uncomfortable truth. Bitcoin does not reward belief. It rewards patience. It rewards liquidity. It rewards positioning. Most retail investors do not have those advantages. They buy near emotional highs. They sell near emotional lows. They get shaken out. Meanwhile, billionaires diversify. They allocate small percentages. They hedge downside. They accumulate during fear. They wait for narrative reversal. They are not trying to double their money in 1 month. They are trying to survive cycles. Now zoom out. What happens when Bitcoin falls during global uncertainty? Risk assets fall together. Liquidity tightens. Credit stress rises. Retail exposure gets cut first. Large funds rebalance. Wealthy investors move into defensive assets temporarily. Then they reallocate back into high growth risk during weakness. Retail is forced to exit at the worst time. This is not personal, this is structural. And here is where it becomes dangerous. Retail believes Bitcoin is protection. Institutions treat Bitcoin as a tool. Those are two very different philosophies. When you believe something is protection, you hold blindly. When you treat something as a tool, you adjust exposure, you hedge, you scale, you manage drawdowns. Retail worships. Institutions calculate. Right now, price is falling, fear is rising, liquidations are occurring, and somewhere in the background, capital is quietly rotating. You're watching red candles. They're watching liquidity maps. You're checking your portfolio every hour. They're checking volatility metrics. You feel stress. They feel opportunity. That emotional gap is the transfer mechanism, and it repeats every cycle. Now think about billionaires specifically. High net worth investors rarely hold one asset as salvation. They hold diversified portfolios. They own real estate. They own equities. They own private equity. They own gold. They own bonds. They own cash reserves. Bitcoin for them is allocation. For retail, it is identity. When price drops 20%, retail questions life decisions. When price drops 20%, a billionaire checks if exposure is still within allocation range. If not, they rebalance. Rebalancing during drawdowns often means buying more. That is how cycles create upward long-term trends. But that process destroys emotional investors in the middle. Now add leverage. Retail often trades on leverage. Retail uses borrowed capital. Retail uses margin. When volatility spikes, leverage gets liquidated automatically. Positions close without permission. Institutions use leverage too, but they structure it differently. They manage risk parameters tightly. They have access to cheaper capital. They do not get wiped the same way. This is not fair. Markets are not designed to be fair. Markets are designed to reward structure. Right now, Bitcoin falling feels like chaos, but underneath the chaos is order. Liquidations clear weak hands. Price stabilizes. Accumulation begins quietly. Narrative shifts slowly. Then retail returns near the top again. That is how cycles feed themselves. The question is not whether Bitcoin will rise or fall next week. The real question is who survives the volatility. And survival in markets has very little to do with belief. It has everything to do with positioning. Right now, retail positioning is emotional. Institutional positioning is strategic. And that imbalance is why wealth continues concentrating. Bitcoin falling is not the real story. The real story is who controls the pipes. Most people think price is driven by buyers and sellers. That is only partially true. Price is driven by liquidity. Liquidity is controlled by institutions. When Bitcoin traded mainly on crypto exchanges, volatility was wild but contained. Now Bitcoin trades through ETFs, through Wall Street products, through regulated funds, through custodial banks. That changes everything. When an ETF receives inflows, Bitcoin rises. When an ETF sees outflows, Bitcoin falls. Retail thinks they are buying freedom. They are actually buying a financial instrument controlled by large asset managers. And when billions flow into Bitcoin ETFs, the price moves up rapidly. When billions flow out, the price drops rapidly. Those flows are not random. They respond to macro stress. They respond to interest rate expectations. They respond to risk appetite. They respond to political climate. Now think about this carefully. Who controls the largest Bitcoin ETFs? BlackRock, Fidelity, major financial institutions. The same institutions that control traditional markets. The same institutions that move trillions across bonds and equities. Bitcoin is now plugged into that machine. That machine does not care about ideology. It cares about capital rotation. If macro conditions tighten, capital exits risk. If macro conditions ease, capital enters risk. Bitcoin is classified as high risk. When stress hits the system, Bitcoin is sold first. Retail sees betrayal. Institutions see portfolio adjustment. Now bring politics into this structure. When political leaders speak about crypto, markets react. When Trump signals pro-crypto policies, sentiment rises. When regulatory agencies soften language, optimism spreads. But sentiment is not structure. Sentiment drives retail. Structure drives institutions. Policy announcements may create short-term spikes, but ETF flows and macro liquidity determine sustained direction. You may believe a politician supports Bitcoin, but if liquidity tightens, price will still fall. You may believe billionaires endorse crypto, but if risk metrics signal caution, allocations shrink. This is the cold truth of capital markets. Emotion is loud. Liquidity is silent. Retail watches speeches. Institutions watch treasury yields. Retail watches tweets. Institutions watch credit spreads. Retail chases narrative. Institutions calculate exposure. Now imagine a scenario. Global uncertainty rises. Markets wobble. Bond yields fluctuate. Volatility spikes. What happens to Bitcoin? It drops. Not because the idea failed, but because liquidity contracts. During contraction, asset managers reduce exposure to volatile assets. That includes crypto. That includes growth stocks. That includes speculative positions. They do not need to believe Bitcoin is bad. They simply reduce risk. That reduction creates sell pressure. Sell pressure triggers fear. Fear triggers retail selling. Retail selling amplifies the move. Liquidations cascade. Price accelerates downward. At the same time, long-term allocators prepare. They do not buy immediately. They wait for stability. They watch for capitulation. They watch for exhaustion. When retail gives up completely, accumulation begins. That is the silent phase. No headlines, no influencers celebrating, just quiet wallet growth. You will not see it on mainstream news. You will see it months later when analysts publish reports. By then, price has already moved. This is how power uses time. Retail uses urgency. Institutions use patience. Now think about billionaire exposure specifically. When a billionaire says they own Bitcoin, what does that mean? It usually means a small percentage of net worth. 5%? 2%? Maybe less. For retail, Bitcoin may represent 50% of portfolio. That difference alone changes psychology. A 10% drawdown for a billionaire is minor. A 10% drawdown for retail can be devastating. When fear spreads, retail feels existential risk. Institutions feel statistical variance. This is why they survive cycles, and this is why wealth concentrates. Now consider derivatives. Institutions do not just hold Bitcoin. They trade futures, they trade options, they hedge with puts, they arbitrage funding rates, they use complex strategies invisible to retail. Retail sees spot price. Institutions see volatility surfaces. Retail sees red candles. Institutions see implied volatility premiums. When price drops, institutions may profit through hedges. Retail simply absorbs loss. The structural asymmetry is the real threat, not price volatility, not political headlines, structure. Now add geopolitical tension. War risk, debt risk, monetary policy shifts. All of these increase uncertainty. Uncertainty tightens liquidity. Liquidity tightening pressures risk assets, Bitcoin included. Retail may interpret this as collapse of belief. Institutions interpret this as macro cycle. The difference in interpretation drives opposite behavior. One panics, one plans. Now consider the narrative of strategic reserves. Governments discussing digital asset reserves creates optimism, but government discussion does not eliminate volatility. If anything, it integrates Bitcoin deeper into state-level strategy. Integration means correlation. Correlation means Bitcoin moves with macro forces. It becomes less independent, more connected. That connection exposes it to broader market stress. Retail often believes Bitcoin is outside the system. The truth is more complex. Bitcoin is becoming part of the system. And once an asset is part of the system, it behaves like the system. That means it rises during expansion. It falls during contraction. It benefits from liquidity. It suffers from tightening. Institutions understand this deeply. Retail often does not. Now pause and ask a harder question. If Bitcoin is part of the financial system now, who benefits most from its volatility? The entities that can manage risk, the entities that can hedge, the entities that can rotate capital quickly, the entities that can withstand drawdowns. Those entities are not small investors. They are funds, banks, billionaires, asset managers. The more Bitcoin integrates into Wall Street products, the more Wall Street dynamics dominate price. Retail enthusiasm no longer controls direction. Capital flow does. And capital flow is controlled by those who manage trillions. This is the structural evolution of Bitcoin, from outsider rebellion to institutional instrument. And instruments are used strategically, not emotionally. Right now, price weakness may look like chaos. Underneath that chaos is systematic repositioning. Retail is reacting. Institutions are adjusting. An adjustment always beats reaction. The fear phase is the transfer phase. When volatility peaks, ownership shifts. Weak hands exit. Strong hands accumulate. This cycle has repeated multiple times. Each time, wealth concentrates further. Each time, retail re-enters higher. Each time, the narrative resets. This is not accidental. This is how liquidity cycles operate. You're watching candles. They are watching capital flow. That difference determines survival. Now the real question begins. If Bitcoin falls, if retail panics, if institutions hedge, if politics influences headlines, who is actually protected? Because this is not about price, it is about survival. Billionaires do not survive because they predict perfectly. They survive because they layer protection. Crypto is not their plan. It is one piece. Gold is one piece. Real estate is one piece. Private equity is one piece. Offshore structures are one piece. Multiple bank relationships are one piece. They do not trust one asset. They do not trust one jurisdiction. They do not trust one narrative. They distribute risk. When Bitcoin falls, they are not exposed entirely. When gold drops, they are not exposed entirely. When equities crash, they are not exposed entirely. Their wealth is layered. Retail often concentrates. The concentration creates fragility. Fragility creates panic. Panic creates bad decisions. Bad decisions create permanent loss. Now think about something deeper. When global uncertainty rises, where does billionaire capital go first? Liquidity, cash equivalents, short-term instruments, high-grade bonds. They increase optionality. Optionality means freedom to deploy capital when others cannot. When markets collapse, the wealthy do not scramble. They wait, they deploy when discounts appear. Retail does the opposite. Retail deploys near highs. Retail has no liquidity left during crashes. Retail sells to survive. Institutions buy to expand. That is the wealth transfer mechanism. Now bring Bitcoin back into the picture. When Bitcoin crashes sharply, what happens psychologically? Retail questions belief. Retail doubts the system. Retail experiences stress. But for a billionaire, Bitcoin is volatility exposure. It is asymmetric upside. If it goes to zero, it does not destroy them. If it multiplies, it amplifies them. That mindset changes behavior. Retail believes Bitcoin is the lifeboat. Billionaires treat Bitcoin as a speedboat. Very different. Now consider systemic risk. Debt levels are extreme globally. Interest rates fluctuate aggressively. Geopolitical tensions are rising. Monetary systems are under strain. In this environment, volatility increases across all assets. The wealthy do not panic during volatility. They anticipate it. They prepare for it. They assume instability. Retail hopes for stability. Hope is not strategy. Preparation is strategy. When markets fall, billionaires often increase allocation to real assets, land, infrastructure, energy, commodities, assets tied to production. Why? Because paper assets fluctuate violently. Real assets anchor wealth. Bitcoin may be part of that hedge. Gold may be part of that hedge. But neither is exclusive. The protection is diversification plus liquidity. Now think about something uncomfortable. When fear spreads across retail investors, narrative control shifts. Media amplifies panic. Social media amplifies panic. Price action amplifies panic. Meanwhile, institutions quietly analyze balance sheets, liquidity ratios, and global capital flows. They do not need hope. They need math. Retail wants certainty. Markets offer probability. That difference destroys confidence, and confidence collapse is what transfers ownership. Right now, if Bitcoin is falling, retail feels threatened. But the deeper threat is not Bitcoin. The deeper threat is structural disadvantage. If you operate emotionally in a liquidity-driven system, you will be harvested. If you operate without liquidity in a contraction cycle, you will be forced to sell. If you operate with concentration in a volatile environment, you will feel pain. That is the pattern repeating across cycles. Bitcoin did not remove power structures. It integrated into them. Political leaders support crypto for strategic reasons. Asset managers package crypto for strategic reasons. Billionaires allocate to crypto for strategic reasons. Strategy is the key word. Retail often operates without one. Now imagine the next global shock, a debt stress, currency instability, energy crisis, geopolitical escalation. When that shock hits, volatility across assets will spike. Bitcoin will not be immune. Equities will not be immune. Nothing volatile will be immune. The only immunity comes from structure, liquidity, diversification, patience, optionality. Those are billionaire tools. Not because they are smarter, but because they are positioned differently. You can admire Bitcoin. You can criticize Bitcoin. You can support political leaders. You can reject them. None of that changes structure. Markets reward positioning. Markets punish emotion. Right now, fear around Bitcoin is exposing positioning gaps. Retail is discovering how exposed they are. Institutions are measuring how much more they can accumulate. That is the uncomfortable reality. This is not about one crash. This is about understanding how capital behaves during stress. If you understand that behavior, you stop reacting. If you stop reacting, you survive. If you survive, you compound. The wealthy do not chase every wave. They build systems that survive waves. Crypto is a tool. Gold is a tool. Politics is a variable. Liquidity is power. The real divide is not Bitcoin versus banks. It is structure versus emotion. And the side that understands structure always wins long term. If you want to understand how capital actually moves during instability, if you want to decode what powerful investors do before the headlines change, if you want to stop reacting and start positioning, then you're in the right place. Because we are not here to chase hype. We are here to understand power. Stay close to this channel, not for noise, for structure. The next cycle will not wait for anyone. And the difference between reacting and preparing decides everything.